Welcome to The Explainer. Today, we are diving deep into one of the most fascinating and, frankly, confusing companies on the planet, a true tech giant that everyone knows, but almost no one knows what to do with. Yep, we are talking about Alibaba.
So let's just get right to the heart of it, shall we? How is it possible that a company this massive, with revenues in the hundreds of billions, is also seen as one of the riskiest bets in tech? That's the puzzle, right? The story of incredible, world-changing growth crashing right into a wall of politics and global tension. Now, to even begin to understand this contradiction, you have to know what Alibaba looks like today. Because, and this is super important, it is not the same company it was just a few years back. In 2023, they did something drastic. They split themselves up into 6 different parts. And even with that huge reorganization, you can see that the original engine is still what drives the whole machine. The Taobao and Tmall group, that's their big e-commerce sites in China, that chunk still makes up 43% of the revenue. This is the cash cow. This is what pays the bills and funds everything else. So think of it like this. You've got this family of businesses. You have TDG, the core engine. Then you've got what they hope are the future growth stars, Cloud Intelligence and the international e-commerce arm, AIDC. And then you have the support crew holding it all together. Cainiao, their massive logistics network, local services for stuff like food delivery, and the digital media group. The big idea here was to let each of these units run a lot more freely.
Okay, so what's the good news? What's the optimistic take on all this? Well, in investor speak, we call this the bull case. And it basically argues that if you can just tune out the noise and look at the fundamentals, you'll see a growth engine that is absolutely ready to roar back to life.
And the whole bull case really starts right here. The core business, that big e-commerce cash cow we talked about, it's stable. After a really tough stretch, it's showing solid signs of life again, growing at a healthy 9% year over year. You need that foundation to be strong, and it looks like it is.
But here's where the real excitement comes in. It's all about the new growth drivers. The international business is rocketing up at 22%, and the cloud business is not far behind at 18%. I mean, look at that. They're both lapping the core business, which tells you the strategy to find new fuel for the fire is actually working.
And if there is one single number that defines the bull case, it's this one, 7. For 7 straight quarters, that's almost 2 full years. Revenue from Alibaba's AI products has been growing by triple digits. This isn't some fuzzy plan for the future. This is an explosion that is happening right now.
All right. I know what a skeptic would say. You'd look at the numbers and go, whoa, hold on a second. Their free cash flow just fell off a cliff. A 53% drop? That looks pretty scary on the surface. It's a totally fair question. Is the company secretly in trouble?
Well, according to the company, the answer is a hard no. They say this isn't a sign of weakness, it's a strategic weapon. Alibaba is pouring billions into building out its cloud and AI infrastructure. It's a massive investment, sure, but it's the exact same playbook Amazon and Microsoft ran to build their cloud empires. You have to spend big today if you want to own tomorrow. It's an arms race.
And to put a final bow on the bull case, just look at this number, $16.5 billion. That's how much cash they returned to shareholders last year in dividends and stock buybacks. Look, a company in distress hoards cash. A company that is confident about the future and thinks its own stock is a bargain, well, it does this.
Okay, but for every bull, there's a bear, and the case against Alibaba is a powerful one. It's a story driven almost completely by things the company can't control. We're talking about the geopolitical storm. This timeline pretty much says it all. This is the source of all the fear. It started back in 2020 when Beijing suddenly canceled the Ant Group IPO. That kicked off an intense regulatory crackdown on all of China's tech giants, which ended with Alibaba getting hit with a record-breaking $2.8 billion fine. And even though that period is officially over, the ghost of that crackdown still hangs over the stock.
And that leads us to maybe the single biggest threat to that whole AI bull case. You see, that entire growth story hinges on one thing: super advanced computer chips. U.S. export controls are making it way harder for Chinese companies to get their hands on the best chips from designers like NVIDIA. This creates a potential choke point that could basically suffocate Alibaba's most important growth engine.
This really shows you the trap Alibaba's cloud business is in. Inside China, government policies give it a protective moat, shielding it from global competitors. But in the West, those same ties to the government create a huge barrier. Data security concerns make it almost impossible for them to compete with Amazon or Microsoft. So it's protected at home, but effectively blocked abroad.
So,
How does the market make sense of all this? What happens when you throw the powerful bull case and the terrifying bear case into a blender? You get one very clear result: a massive, massive discount on the company's stock price. And you can see it plain as day right here in the numbers. Just look at the price-to-earnings ratio. It's a simple way of seeing how much investors will pay for $1 of profit. Alibaba trades at a multiple of 13. Now compare that to Amazon at 35. Even its Chinese competitor Tencent is at 22. On basically every metric you look at, Alibaba just looks cheap. This is what people call the China discount.
And hey, this isn't some fringe idea. The folks on Wall Street overwhelmingly agree. The consensus is that the stock has a potential 25% upside from here, and some models calculate that it's trading at a wild 42% discount to what it should be worth based on its business alone.
So where does this all leave us? Let's try to pull all these threads together into one final, clear thesis about what you're really getting into with Alibaba.
You know, our source material summed it up perfectly. At the end of the day, it really just boils down to this. An investment in Alibaba is a bet. It's a bet that the company's incredible growth engines and its super attractive valuation will, in the long run, be more powerful than the very, very real geopolitical risks.
Which leaves us with the final $290 billion question. Is Alibaba a classic value trap? A stock that looks cheap for a very good reason because the risks are just too high to touch? Or is this a historic opportunity to buy a world-class company at a massive discount simply because everyone else is scared? Well, that's what the market is trying to figure out.